Okay, in this video I'm going to give you an example of what happens when a stock moves up and down. In our case, we're studying the Qs, the ETF. And what happens to the option that you've purchased when the underlying stock, in this case ETF, moves up and down at different price points. Now, if we take the Qs, and you can see that we have, remember, we have our call options and we have our put options. One of the nice things about the Thinkorswim platform from TD Ameritrade is the fact that it gives you lots of information in one simple to read screen. And we can change our layout. The current layout that I have is the last trade, the net change for the day, in the bid and asks on each of the calls and the puts. If I wanted to, I could change that, and you could do theoretical price and the current market, volume and open interest. You could do probabilities of expiring and their delta. You can do position, intrinsic and extrinsic value, and you can also do the delta, gamma, theta, and vega, which are the Greeks that we haven't talked about yet, but we will be getting into it in future videos. Let's take a quick look at position, intrinsic, and extrinsic. Now, if we had a position in this ETF, our position would show up under the position column. In addition, we have other information that we didn't have before. We have the extrinsic value, we have the intrinsic value, and we still have the bid and ask price. Now, as you can see, the deeper we go in the money, right now the Qs are trading at 57. So the at the money call and puts are the 57 strike prices. As we go deeper into the money, you can see the intrinsic value increases as we get deeper into the money. The extrinsic value, or another word for that is the time value of that option, decreases as we get deeper into the money. That's because there's more time value placed on at the money options or out of the money options. Actually, the most time value is given to the at the money options. That's why you see, in this case, the Qs have the 57 strike price Q calls have an extrinsic value or time value of about 72 cents. The extrinsic value of the 57 strike put has 82 cents in it. But as you go deeper out of the money and deeper in the money, you can see that changes dramatically. The farther you go out of the money, the less extrinsic value it has. And the deeper you go in the money, the less intrinsic value it has as well. That's because an option is comprised of both intrinsic and extrinsic value. As you get deeper into the money, in this case we're looking at the puts over here. Let's take the 68 put. It's currently trading between a bid of 11 and an asking price of 11.15. It has an intrinsic value of $10.93, of which, in addition, it has an extrinsic value of about 14.5 cents. Now, there's also something else that you need to consider when choosing an option. And we're going to be talking about in the next series of videos of how to select an option to trade. In most cases, when you're buying an option, you want to buy real value and not time value. When you're buying an option, you're going long that option. If you're selling an option, you want to sell extrinsic value. You want to sell time value. Now, because these options only have about 7 days left to trade, you can see that the December 11, 58 strike price has a very small extrinsic value. There's very little time value left in those options. The market is pricing these at 35 cents. The 59 strike price is only priced at 12 cents. In other words, they're determining based on probabilities of whether or not the Qs would actually rise above the 59 strike price or the 58 strike price in order to make a profit from the purchase of these calls. Now, when you're purchasing a call option, a single call option, it gives you the right to buy that stock at that strike price, but an equivalent of 100 shares. So for each call option is equivalent to purchasing or having the right to purchase 100 shares of stock. And when you're actually but the amount of the change of the option depends on what's called the delta. The delta will determine the actual price change. Even though you have the right to purchase 100 shares of stock, at expiration, that will become either intrinsic or extrinsic value. Until that time, the delta will determine actually how much that option will move in price relationship to its underlying instrument, in this case the Qs. So if we take a look at let's take a look at the Greeks. We'll change our layout to delta, gamma, theta, and vega. And you'll see that the delta for an at-the-money option at the 58 strike price is 0.30. That 0.30 means that for every dollar that the Qs rise, this option will rise 30 cents. So you can determine that if the Qs rise to the strike price of 58, it will the price of these options will rise to approximately 65 cents, rising 30 cents based on the delta for each option that you purchased. So a single option will rise by 30 cents. If we rise to 58 today, then that option will be priced at approximately 65 cents. These delta numbers will change on a daily basis. It determines the amount that the stock will move based on its current strike price. So, for example, if we go down to the 50 strike price, it's the option there is currently priced at 703 bid, 709 asking, and and the delta is at 0.94. So if the Qs rise by $1, this option price will rise by 94 cents. And that's what the delta does. It helps you determine how much of an increase in the option price will be a gain for you if the underlying ETF should rise by $1. You can also determine, if it rises by 50 cents, that half of that delta will be added to the price of the option of approximately, let's say, 47 cents. So if the underlying Qs will rise by 50 cents, the option at the 50 strike price will rise by 47 cents. So it gives you an idea of what will happen as the market moves. Now you can tell that out of the money options, in this case out of the money call options, are priced at very, very little. They're very, very small asking prices here, 2 cents, 1 cent, 1 cent for most of the higher strike prices out of the money. That's because the market is not valuing the fact that they're determining that there's very little probability that as of today the Qs will rise into the $61, $62, $63 price range. That is quite a move for the Qs. But if we take a look at, let's take a look at another expiration date. Now, options have an expiration on the third Friday of each month. Actually, they expire the next day, which is the non-trading day. However, they're marked to market at the end of the third Friday of the month. In this case, the December 11 options will expire on Friday, December 16th. At that time, they will cease to trade. If you are long an option that is out of the money, in this case, let's say you were long the 60 call options, you will have lost the premium that you paid for that option, and you will not see any addition or subtraction in your account. Now let's take a look at a different month. Let's go to January for 2012, and you can see that the values of the out-of-the-money call options are quite a bit different. In fact, they're more. You could go up to the 60 strike price, which was valued at only 1 or 2 cents on the December options, and these are priced at 55 cents. That 55 cents represents a, if you want to, you could call it a hopeful anticipation that the market will rise to the 60, the Qs will rise to the 60 price level by January 12th. In actuality, in order for you simply to break even on an out-of-the-money call option, the Qs need to rise $60.56 to break even on that particular option. And then anything above that would be pure profit. On the other hand, if you were to sell that option, you would receive 54 cents in funds into your account immediately upon selling it. And then if the market should stay the same, or even rise a little bit, maybe to the 59 level, or go down, you'd be able to keep that entire 54 cents that you wrote that option for. In other words, you wrote the option, someone else purchased it from you, and if they are wrong and the market does not rise to the 60 price level or higher, then you will be able to keep that entire premium that you received as the seller of that option. Now, there's a couple other things that, remember, we talked about delta, and that affects the price of the option. In other words, even if the market were to rise dramatically today, up another $1 to the 58 level, the price of this option will only increase by 24 cents. So if you were to purchase this option and the Qs rose above, rose another $1 to the 58 strike level, this option would only rise by 24 cents in profit. So if you purchased it at 55 now, it should be worth 79 cents if the Qs rise to $1. So the delta will determine how much you're going to be profiting today. The delta will change on a daily basis. But today, if it rises to 58, you should receive a 24-cent profit. You can see that the profit is greater as you go deeper into the money. However, the compensating factor, of course, is that they are more expensive. You can purchase a out-of-the-money call for 55 cents. You purchase perhaps an in-the-money call at the 50 strike price level at $7.27, and it represents about a 12 times more expensive option than the out-of-the-money one. However, if the Qs were to rise $1, you'd receive a 90-cent profit on this position, and on the 60s you'd receive only a 24-cent profit. In the case of the 60 option, if the Qs were to rise for $1 and you receive a 24-cent profit, that represents about a 43% return on your investment. In contrast, if you were to purchase the 50 strike price option, with the 90 delta, if the Qs would rise by $1, you'd receive a 90-cent profit. However, the return on that investment is approximately 12%. So you can see the percentage gains are much greater for out-of-the-money options than they are for into-the-money options. But, of course, there is also a bit of a risk in both style of options if you're purchasing them and the stock drops. In this case, our ETF drops. You'd be losing money. The good news for the out-of-the-money option is that if the Qs drop by $1, you'll only be losing approximately 24 cents of your investment. That's still, on a percentage basis, a very large portion of your investment, about 42%. But you'll only lose 24 cents net. On the 50 option, on the 50 strike price option, if the Qs were to fall by $1, you would lose a total of 90 cents. So the total aggregate amount of your loss would be greater than it would if you purchased the 60s. So there are advantages and disadvantages of both style of options, either buying in the money options or at the money options or out of the money options. And to help you determine how much profit or how much loss you could actually have as a result of purchasing those options, all you have to do is look at the delta, and based on a single dollar move in the Qs, you would determine immediately what your profit or loss was during that price move. The same thing is true for put options. If you take a look at the deltas, you can tell, and now deltas for options are always negative. That means that as the market drops by $1, you will gain 18 cents if you were to purchase these 52-cent puts. And if the market actually went up $1, you would lose 18 cents on these 52 puts. The strike price 52. And the same goes for in the money put options. This has a delta of minus 93 at the 65 strike price, and if the Qs were to drop by $1, you would have a gain of 93 cents profit if you were to purchase at this time. And if the Qs went up $1, you would lose 93 cents as well. Now, as you get closer to expiration, as I mentioned, one option is equivalent to the ability to purchase 100 shares of stock if you're purchasing a call, or you have the right to short 100 shares of stock if you were purchasing a put. And the deltas will actually start to decline and decrease the closer you get to expiration. So, for example, right now, since we're on the January 2012s with 42 days left in these options, the delta for the 60 strike calls is approximately 0.24. If we go back to our December options, you'll notice that the 60 strike price has a delta of only 0.04. That's because the closer you get to expiration, it's an either-or situation. In other words, you're either in the money or you're out of the money. If you're out of the money, you eventually getting to expiration date, you will have zero delta. In other words, there's no opportunity for that option to move as you get closer to expiration. You either are in the money or you are out of the money, and at the last minute of trading, all of these, in the last second of trading, all of these out of the money options will go to a zero delta. And all of the in the money options will go to a 1.00 delta. That means that for every penny that the underlying Qs move, the option will move in sync and in conjunction with the move in the underlying stock. So eventually we'll get down to absolutely zero with out of the money options for the delta, and in the money options we'll get to 1. And you can see that already in effect right now with 7 days left. Most of the options that are deep in the money have already gotten to a delta of 1. And a great deal, the number of the out of the money options have already gone to 0 or very low numbers. If we go back to the January options for 2012, which have 42 days to expiration, you can see that there's still some delta left in these out of the money options, and there's still a lower delta on these in the money options, and those will continue to gradually increase in delta as long as they remain in the money closer you get to expiration dates. So it helps you determine what your potential profit and loss is. If you're expecting a very big move in the Qs, you would be better off probably buying at the money options that will rise and then gradually increase the delta as they get further into the money. giving you some sort of buffer and an additional profit as it continues to move in your direction. The same is true with the puts. If you were to purchase puts that are in the money or at the money, your situation would normally be greater in your favor if you were expecting a very large move to come within the time frame that you need it to come. In other words, you have 42 days before expiration, and in most cases, unless you're expecting a very large move, an at-the-money put option is a very, very short-term purchase. You only want to purchase these when you know that a large move is coming, or you anticipate a large move is coming on that day or maybe a day or two ahead of time, because otherwise, if you don't, what happens is you begin to lose value. The extrinsic value of an option will lose value as you get closer to expiration. So, for example, if we go back to our position intrinsic and extrinsic value, you can see that the extrinsic value of this 57 strike put is $1.98, which is the value of this option right now because it is out of the money. There is no intrinsic value in this option. The intrinsic value is totally comprised of its entire price of that option. But as you get closer to expiration, we'll go back to our December options that have 7 days left. You can see that the time value has eroded the price of these options to the point where they are half or less than half of what they used to be when they were 42 days to expiration. So you only have an 80 extrinsic value of 0.87. So as time goes on, there's two things that are absolutely true about options. Number one is that they will expire. At some point in the future, they will expire. And it's also true that all out-of-the-money options at expiration expire completely worthless. All right, let's get into some specific examples in the very next video.